Hi, everyone. Thanks for joining us for Demystifying Revenue Recognition for Subscription Companies. We're excited to have you here today to join our panelists as we discuss a pretty interesting and complex topic here. Revenue recognition, as most of you know, is an area that's undergone some substantial regulatory changes and is also one of those rare areas where sales leadership and finance leadership have both strong opinions and vested interests in the solutions. So let's start with some basic introductions and a bit about the firms you'll see today. Jay, we'll start with you. Why don't you tell us a little bit about yourself and a bit about AppWrap?
Yeah, thanks for the opportunity here. Looking forward for this conversation here. I'm a CPA, chartered accountant, come through the finance and accounting background into the IT side of the world. At AppWrap, we as a company, we focus on supporting NetSuite ecosystem for more than 50 customers. Here, in AppWrap, focus on the order to cash automation and the revenue recognition areas. Thanks, Alan.
So here at Standav, we're leaders in transforming enterprise sales systems. We work with enterprises to reimagine their quote-to-cash experience with CPQ, billing, RevRec, etc. We help our clients with order-based revenue recognition to help forecasting, billing-based revenue recognition, as well as invoice revenue recognition solutions. So with that intro to our company, let me introduce you to the rest of the panel. It's my pleasure to introduce you to Ludmila Maranjavej. My apologies on the last name. She's a CPA and VP Corporate Controller from AdPar. Ludmila, why don't you tell us a little bit about yourself and what your firm does?
Thank you for joining us today. So I started my career many years ago as an auditor at Ernst Young, been there for 12 years, providing the audit for the high-tech and biotech company in Silicon Valley. After that, I moved to Cisco, and at Cisco, I was at the very beginning of the project, which some of you may remember, which started as a convergence of the IFRS and US GAAP. However, this project didn't go on, but it transitioned into several streams, and one of them was what today became the ASC 606, or the new revenue guidance as we all know it. So after the Cisco, I joined newly IPO company called MobileIron, and that was my first 606 implementation project. I was in charge there for accounting aspect and system aspect of the system implementation. And currently I'm corporate control at AdPar, and we just finished the 606 implementation here, and we are the last strides of the system implementation as well.
Thanks, Ludmila. It's a pleasure to have you here. I think you're going to bring a lot to this conversation. Finally, we have Brian Campbell, Senior Business Systems Analyst at Spirient Communications. Brian, why don't you tell us a little bit about yourself and your company and what your folks do?
Thanks to everybody for the opportunity to join today's panel. I've been with Spirent Communications for the past 8 years. I'm responsible for support and development of the financial systems that support our business, including the J.D. Edwards ERP system and Salesforce using Aptus Revenue Management. Spirent itself is a global tech company. We have offices around the world based out of Calabasas. We have business units in the UK, in Asia, and then supporting sales offices in many other countries. We manufacture test and assurance systems for wireless and connected devices, network systems, including IP, Ethernet, and cloud and GPS technologies. So we sell hardware, we sell support, and we sell professional services. So we have a good mix of revenue streams that drive our income statement. We're based out of Calabasas, California.
Brian, I appreciate that introduction. I think you'll be a great help for us here. Now that we've met the panel, why don't we go over our agenda very briefly. First, we're going to do some questions with the panelists that I'll ask that'll help kind of outline the theme and get some of their insights. Then I will briefly share some details on Standav's subscription management readiness framework, our ERP integration methodologies, and our billing quick start offerings. But I promise I'll make that very brief. This isn't a sales pitch. This is just a familiarization for you. And finally, we're going to have an opportunity for the audience to ask panelists questions. In fact, as we're going along, if you have a question, please put it into the Q&A section of the chat feature. If it's timely to the topic we're on, we'll address it at the time, and if not, we'll move some of the questions to the end. let's jump right in. Jay, why don't you start by telling us what are some of the common business challenges you've seen for revenue recognition?
I think if you look back, it is about how you structure your whole organization to allow, a revenue recognition in there, right? And what is your nature of the business? Those are the two different things that actually drives, the revenue recognition aspects of the company. How congruent are your systems, interacting with each other? How critical is your subscription model? And how flexible is that model to meet customers' requirement and the impact from a revenue recognition perspective?
Brian, why don't you tell us what you see some of the essential elements that are necessary for a smooth subscription management system?
Well, I mean, the main thing I see is that you need seamless integration between your systems that are used to track sales, revenue management, and eventual integration to your system of record, which is typically your ERP system. And what I've found is restrictions in one system can really dictate how you configure your functionality in other systems. For example, our ERP system holds all of our sales order information integrated from Salesforce. Our products are configured in Agile and integrated to the sales system and also our ERP system. And eventually orders are shipped and invoiced out of the ERP system. And then those records are integrated back to Salesforce to drive your revenue recognition entries that end up back in your GL. So it's really important to have, all these systems in sync at all times. Your revenue system and recognition can be dictated by the way you invoice your orders in your ERP system, or at least it is with us. So keeping these systems aligned along with how management wants to run your business can become a challenge because, your management's always looking for new initiatives and new ways to support your customers. So you don't want these restrictions to hold you back from recording your revenues.
Thanks, Brian. Jay, as you think about it, what are the typical products that you see in a subscription environment and how do they affect revenue?
You'd be really surprised on how many different items and, in an accountant's term, a performance obligation there in a subscription environment, depending on the nature of the subscription. You could have a hardware shipped in the beginning and then a subscription that's tied to it. Like, we recently working with a company which sends baby monitoring device with a subscription, and how do you handle revenue recognition for that? You would actually have a term license and things like that may have a different connotation from a subscription. Just within the same subscription universe, you could have some companies that would say you can eat anything you want subscription, like you just have subscription to the company's product, versus more and more companies are now trying to split that one subscription product into separate units and trying to upsell things around it. It could be like, hey, I want to increase your seat. There could be an add-on. There could be an increased storage capacity. There's so many different subscription components itself that comes in. Setup and professional services is a completely different animal altogether, right? If you think about smaller companies, let's say Zoom, or not necessarily smaller anymore, but more standardized companies like Zoom, you start a subscription, you run. There's not so much of a setup fee and things like that. But a large ERP or a CPQ for that matter requires extensive customization, and you can't just turn on the system and use it the first day. And in fact, we've known certain subscription companies that is just sold as a framework. So what you get day one is just the framework, and there's extensive, professional services that is required before you can start realizing value of it. That actually has a direct impact on when you can start recognizing revenue. And then there are those miscellaneous performance obligations like trainings, and certifications, use it or lose it clause, and things like that. And then there is that, Pandora's box of other performance obligations that nobody talks about, but really need to be considered about, is like your SLA, your price blocks, and, other material rights and variable considerations. All of these definitely, Alan, if you think about it, has a significant impact on your revenue recognition, especially with the subjective nature of 606.
Yeah, absolutely. I can see how the complexity can cause different companies to handle this very different ways. So maybe we move over to Ludmila for a moment. As you heard Jay talk, and you think about all these different subscription products and their sale and the various issues and components there, what are your thoughts on how, as a professional, ASC 606 should be applied, and what are kind of the rules and ways of thinking that you apply to those different components Jay talked about?
Sure. Thank you, Alan. So I can talk about the RevRec all day, right? So I'll try to hit the broader areas and the most hot topics that companies are dealing with when implementing 606. Jay mentioned different type of subscriptions, and one key technical aspect of it to understand the difference between SaaS subscription or software as a service, which treated in the RevRec as a service, right? So a series of the same performance obligations over and over and over time, versus term subscription to the sales of the licenses, to the on-prem software. The difference is very vast, right? So, and while the on-premise term subscription is slowly but surely is going away, there are plenty of companies in the industry who are either making a transition or still have the term licenses. And again, as I mentioned, the SaaS subscription deliverables is fairly simplistic. It's over time, the same unit of accounting, and the term license for the on-premise should be treated more as old-fashioned perpetual license with maintenance, support and maintenance agreements attached to it. So Jay also mentioned the setup fees, which pretty much a lot of the SaaS companies tend to offer. It's not as important how we call it. We call it setup fees. It's more important what's delivered behind that. So some companies just use this setup fees as a mechanism to increase subscription fees. And in this case, we really don't need to do anything about that. For other companies, setup fees has a very specific performance obligations, which are professional services to do the implementation, configuration, some customization work. And in this case, the treatment as a professional services, whatever you decide to treat it as a hours delivered performance or completion could apply. Another aspect that I wanted to touch base is some SaaS organizations provide so-called usage-based fees. And that's a whole different ballgame, right? So for some companies, it's going to be considered as a deliverable, as a variable consideration. For others, it won't. And that's a very complex area that certainly needs to be looked into.
I think it's an interesting level of complexity. I think follow-on question for you is, if not handled properly, I'd be curious what you see as some of the potential consequences. Are there fines and penalties and fees? What happens when it's done poorly?
So there are a whole slew of the consequences. The most unpleasant one that we could deal with is the restatement of the financial statements, which could be extremely costly and punitive for any sort of the companies, and definitely for the public companies, it's about publicity and it's about consequences. But even for the private companies, I mean, you have users of the financial information who are relying on it, and restatement is never the word that we could want to hear or use or even imagine.
Brian, as you're thinking about some of this, what are some of the challenges of configuring a revenue system to meet the needs that Ludmila's talking about here?
Well, as I mentioned earlier, I mean, you're dealing with a lot of integrated systems, so accurate setup is key. You got to ensure that all your elements are required for the successful revenue recognition is properly configured. Eventually, the revenue data is going to integrate down to your GL for proper recognition of deferrals by either business segment or business unit. Likewise, compensation is often driven by the allocation of this revenue to these business units, so it must be accurate. You got to make sure you're paying your salespeople for the revenue that they're generating. Management needs to be able to slice and dice this data to fit their needs for strategic planning. So all these elements go into to the end result, that your accurate setup, results in these successful conclusions. So you have products that have to be set up with the proper revenue recognition policies. So, for example, your hardware items are immediately recognized typically. Your support items are similar to subscriptions. They're ratable over a certain period of time, whatever you're selling support at a 1 year or 2 year basis. And then you have milestone based revenue, where, say, you've put an engineer out on location at a specific with a specific customer, and they have to complete that project and reach those milestones in order to record revenue, and all that ends up into the proper business units. So management has that accurate financial reporting. And then setting up your accounting control records, so when you integrate these entries, what we do is we, once a month, we integrate all of our revenue and deferrals from our Aptus system over to our JD Edwards ERP system. So you don't want to be spending critical time at month end reconciling errors and figuring out why things didn't post, or did they hit the wrong account. Companies need to be able to close in a shorter and shorter time frame. So like right now we're on a 2-day close every month. So any errors in posting revenue is really going to delay the entire process. That's the first thing they're looking for at the end of the month is accurate revenue postings.
Jay, why don't you walk us through a bit of the various technological components Brian's talking about, right? We're throwing a lot of acronyms around: CPQ, lead to money, ERP, etc. Why don't you give us a flavor of what are all these technologies we're talking about? How do they influence revenue recognition for subscription businesses?
Sure. I think the world has taken a new turn in terms of this technology, right? Like the 80s and 90s talked about these large ERP, which could do everything in one go, and you don't have to have multiple systems. And with the influx of cloud, the whole world is taking a new turn. And now you're saying, let each department and function decide what is best in breed for them, right? Let them make that individual decision. Let them not be compromised by this one large system. Of course, that's a nightmare for people like Brian, because now they're managing hundreds of applications within their ecosystem. But the reality is, there's a plethora of application that gets involved in a SaaS business. Definitely having an impact to revenue recognition. It is like, customer relationship management, where a quote is created, a customer object is created. How do you structure a customer versus a reseller relationship, right? You have CPQ, where your pricing is done, and of course, a lot of pricing decisions are there, and that also gets involved with contract negotiation, right? The CPQ system is definitely involved there, so that has a direct impact on revenue recognition. You have a billing system, and it could be, the hundreds of billing systems in there right now, but it could be a billing system, and I've also seen companies use different billing systems for different sections of their business, and how do you handle that? And then you also have payment processors like like Stripe or Beaver, and you have the subscription management system itself, like like from a customer success, renewals and things like that, and then you have the different breed of accountants called FP&A team, and they've got their reporting system, which is completely different than all of this, and they want to talk about ARR in their own nomenclature, right? So you have a different system there. And I think Brian mentioned about professional services. So you actually have to have a place to track their capacity, their projects. What happens if it's a T&M project and multiple change orders are passed, and how do you handle that from a revenue recognition? And last but not the least is the revenue system itself, and potentially the ERP. And as you see, many of these systems play dual roles, like multiple different roles. So, and each of them are growing into others' footprint, right? You have an ERP system now going to be a billing engine, or a subscription system, or a CRM. And now you have CRMs that's getting into the revenue recognition area. And in between all of this, there are payment processors who are trying to get into all of these areas. So I think, it's very critical as an organization. The company is aware of all the different systems that they use, what are the new features that these systems offer, and what are the specific areas that the company is using that particular system for?
Thank you for that. I'd like to remind folks on the call, if you have questions for the panelists, please type them into the chat function or the Q&A function of the session, and we'll be happy to answer them in real time in most cases if they're timely to the questions at hand. Jay, let me follow up with you. We talked about a bunch of different components here. Are there systems and unusual platforms that maybe you don't see that often, but that your IT folks and your finance folks aren't even thinking about, that are going to have revenue recognition consequences that they should look for? And kind of my follow-on to that is, how do you audit for that? How do you go find those kinds of things in the first place?
Yeah, I'll give you a classic example, right? So you have a subscription that's going on. Let's say you're calling up Netflix or let's say Zoom or something like that, and you said, I've had terrible reception the last 10 days. And the customer success says, oh yeah, don't feel bad about it. We'll just extend your term by a month, right? It feels so, innocent, and it's great. It's done to keep the customer happy. But on the other hand, on our side, from a revenue recognition perspective, it's got a huge impact. Now you have to extend your software, the revenue recognition. You will have to do a modification, right? Things like that would make it very, very complicated. Brian, do you have any additional ideas here?
Yeah, I mean, we've talked about subscription and kind of products that they're not material, they're not like a hardware product. So we're shipping an actual physical hardware product out to our customers, right? And each of these sales orders, they have shipping terms associated with them. So we have an integration from our different shipping systems, whether they be FedEx or UPS or whatever it is, that sends the result of those shipments back into our sales system. So the revenue accountants have to go in, they have to look at the orders, they have to determine what were the shipping terms, whether, if they're once they leave our dock, can we recognize revenue, or was the shipment rejected for some reason, there was damage. So just because you've shipped and invoiced something does not necessarily mean that you're going to trigger revenue recognition. There's other components there that other accounting rules that are driving the fact of whether or not you can record that to your GL.
It's interesting. Jay, I was thinking back to your prior example. I'm thinking about companies that are high touch with customers. So the cable company, your internet provider, the phone company, those kinds of folks, your lowest level employees could be causing all kinds of ripples and consequences, and they're not even aware that there's such a thing as CPQ, let alone an ERP system. They're just simply sitting in a service portal and creating ripples and consequences that you'd have to account for.
And then, one other example, I want to actually give it to you. Apologize for jumping in here, but I have a customer who provide educational services to college students, and they actually have the customer ability to pass and unpass a subscription, because you've got a break, you don't need that anymore, so you want to pass it, right? And these are students, and the amount of pass and unpass that they do to that subscription system kills us from a revenue recognition perspective. But these are interesting complexities of the business that is required to grow the business. And I think as accountants and revenue accountants and system people, it is our job to keep up with that and not actually put a roadblock on how businesses run.
You want to give the business the flexibility to find revenue wherever they can and enable all of those strange behaviors if they're actually generating revenue for you. So Ludmila, why don't we shift back over to you a little bit? Can you tell us a bit about the audit pitfalls and risks of all these systems and integrations that we have in play? I mean, Jay and Brian have covered an awful lot of different tools here, but there's obviously got to be some danger as well as from an accounting perspective.
It's actually nicely playing into the previous discussion of accountants not being a know people and enabling, or at least not preventing the business from growing and doing what it's supposed to be doing. I would like to talk a little bit on Jay's example when we're extending the subscription contracts. And I think it's extremely important to understand those volume transactions in the business, and absolutely imperative to automate them like in Jay's example, we're extending a contract given 1 month. Well, trust me, as an accountant, I don't want my team to be running around the company and chasing those type of things if I know that those are the volume and normally occurring transactions. So I would like my system to be built the way that could accommodate those kind of things. So on the other hand side, what I found in the system implementation, especially in the AppWrap implementation system, it's very easy to fall into the trap trying to automate every single corner case. And that's another end of the spectrum which we're not necessarily want to falling into. We want to automate, as I mentioned, the volumes of the transactions, and maybe to have a phase 2, phase 3 implementations where we could address should we decide those corner cases. If we think about the audit on the other hand side, I have a couple of examples that are fairly typical, and we're frequently getting questions from the auditors. And the my favorite one is the completeness, right? So when we talk about the data flow, we talk about the CRM, QTC, revenue, and then downstream the ERP, or whatever order it is, right? So because there is several different ways of dealing with this. So my auditors will always be asking me, how do I know that my ERP is complete, right? So, and that's where the reconciliation, either automated or manual, is very, very important. And we should always be prepared to answer this question. It's difficult to prove, but there are ways of doing this. So that would be one of the examples. And finally, what I wanted to share is my pain of needs to balance the evolving business needs with a project of implementing the systems. Like, for example, we have, I don't know, September 30th go live dates, right? But I'm constantly getting bombarded with a new product offering, and it's very tempting to try to accommodate all of those new product offering into my go live date. Well, sometimes it's just impossible, right? And we have to be honest with us. What roadmap and at what time can we be doing what? And at the same time, allowing for the users of the system to do the proper UAT and get it done properly in the manner so auditors can actually come in and audit it.
Excellent, thank you. So we had a question from the audience about what type of use cases, examples do we see for transaction or usage-based pricing? And I think we touched on it a bit when we were talking about communication industry and teleco, that kind of thing. The follow-on question was a bit about what are some of the challenges when you start thinking about transaction and usage-based pricing? And I think, Ludmila, that's probably a good place for you to speak in, and maybe pull Brian in as well on that.
Let me start. So the typical use case, so you mentioned that in your question, it is a telecom industry, right? Very typical, but not only. So at my current company, I do have the usage-based invoicing, and it does create actually an issue on multiple fronts. First one is the billing. So, and maybe that's where Jay and Brian could help me a little bit. What system out there to do the usage-based billing? So far, every time when I dealt with that, it was some sort of the customization, some sort of the not having an available off-the-shelf software that are available in the industry. So that's first thing. And obviously the whole complexity of the revenue recognition associated with that. Do we call it a variable consideration? And do we need to assess the usage-based fees on the onset of the agreement? Or can we treat it as a usage-based and just treat it as billed and basically as recognized revenue? And unfortunately, I don't think that I could expand on that more in this session, but that's a very important topic to discuss with your auditors and the consultants when you design your revenue and the system as well.
Got it. And Brian, do you have a few thoughts for us here on this usage-based?
I think the closest we have for that is actually a new initiative that management has, which is to sell prepaid services. From our perspective, we want to sell, say, $50,000 worth of consulting services that are going to be consumed at varying rates over the next 12 months. That unfortunately does not fit with the way that we've configured both our revenue and our ERP system at this point, because the way we've done it in the past, or how we've done it up until now, is that, let's say you have a sales order with one line on it that says $100,000 of services. well, we've configured it that you have to ship and invoice that entire amount in order to activate your revenue agreements on the revenue management side. Well, we're going to have to decide how we're going to address that. So are we going to address that on the ERP system to where we allow us to, say, split that line out as it's consumed, and then we'll have to make changes on the revenue side to be able to activate portions of that revenue and not wait for the entire order to ship. So, we're actually working through those kind of challenges right now.
Another question from the audience. They'd be curious, and I think, Ludmila, this is probably another question for you. Can you talk more about the stand-ready subscription model with overages? I think it's probably you and Jay that should probably pick this up.
Let me try. So stand-ready subscription model, that's going to be falling into the most typical SaaS subscription business model, right? And if on top of that, you put some overages, right, that could be billed, that's where we need to spend quite a bit of the time in researching of whether those overages could qualify as usage-based fees and basically do not need to be treated as a variable consideration with constraints, or they need to be treated as variable consideration with constraints and assessed in the beginning. And that's why it's very important to properly structure your agreement with the clients, right? So how you bill, it's better to spend some time in structuring it that way, where it doesn't get you into the area of the variable consideration accounting, which could be extremely complex.
Excellent. And Jay, you have some thoughts on this as well?
Yeah, I think overages is an area, especially when you're dealing with large enterprise contracts, gets into that complexities where you have tier-based overage billing, right? And you have different tiers, and these are constantly negotiated over the term of the contract when the overages is going in there. And sometimes, especially on the usage-based accounting, you also need to look at the breakage and what like the subjective assessment of these 606 expect you to go and look at it and say, how much do you think they will actually consume over the period of the contract, and then recognize revenue based on that. It's no more like, okay, you're contractually allowed this much and I'm going to recognize revenue based on that. A lot of subjective thought needs to be put into it, and you'll have to think about it from an industry, from a customer. There are so many subjective elements that needs to be brought in from an usage accounting perspective. But like as Ludmila said, the best dealt way is to push it to be an option and recognize it as we bill it and we're done. We wish we get to that in all different areas, but that's a challenge with the contracting language to get to that.
And let's swing completely the other direction. I have a question from the audience about, and Ludmila, I think this is yours as well. What is the finance perspective on challenges if a business decides to offer a free product to win over customers? So how does that impact revenue recognition for paid customers if they take something that's normally paid and are giving it away to certain customers as a loss leader or a way to entice people into the system? What kind of consequences are we going to see there?
Excellent question. The question that creates a lot of problem and a lot of discussions and the documentation. Well, the truth to be told, that no one prevents business from giving a free product to customers to entice them to stay, to make a contract with the clients, and it should be viewed that way, right? So that's a normal of the business in many situations. Now, of course, the guidance looks at that slightly differently, and we frequently hear the word concession, right? So as an accountant, it's important to understand the difference. So is that the marketing? So are we spending resources and we're giving clients something ahead of the agreement as a marketing, right? Free product, free demo, a couple of months, etc., etc. Or is that a part of the revenue agreement and should be considered in the revenue allocation of the agreement? Unfortunately, I don't think I could give a very good answer, because as frequently the answer is it depends, right? So a couple of the pointers that we could deal with to make accounting a little bit easier, right, is the passage of time when the transactions are delineated in times between, like, for example, the time when we sold one piece of the product and another one. However, it's not always helps, right? So I'm going to leave it at that, that it is a judgmental and certainly very worth talking to the auditors ahead of time to getting their concurrence and agreement on the revenue recognition.
And I think we see this pretty commonly, right? I think about companies that are doing, here's a 30-day license to the entire suite, go use it and play with it. What happens at day 22 when they decide to buy it? How do you deal with those kind of situations? But it has to be something that's fairly common, because I see it all the time. Or drop in the main core product and here's a 30 or 45 day or 90-day trial on one of the ancillary products. What about all the people who already bought it, right? That does cause some interesting wrinkles, I think. Jay, what are we missing here? What about typical other contract terms, things that we haven't thought about or we haven't gotten to so far?
They say cash is king, and let me add this here. The sales commission is the queen, or actually even the mistress in this whole deal, right? You're talking about, the sales team focused on looking at their commission structure and seeing how we could grow that. And fortunately or unfortunately, it's tied to the ARR, right? How your company's ARR, what is considered to be ARR is a very, very tricky question. And these days you're seeing professional services being camouflaged as ARR, completely a different discussion for a different day. But if you see that, a larger company tend to have very structured deal, and it's very tough to modify that deal. But if you're a small company, you're growing into the SaaS business space, or you're dealing with large enterprises, you don't have that liberty. I've once seen a SaaS contract with a car manufacturer with a 2 months right to return, because in car manufacturing, you buy a part, you don't like it, you can send it back. But think about a subscription business, you bought that and you got a 2 months right to return, right? Which is a completely different clause altogether. So things that, would throw a wrinkle in the revenue recognition, are like early cancellation clause or acceptance clause, term for convenience, price lock for more than, normal time period, usage-based price lock, price changes or SLA credits. And sometimes when you're working with a reseller or a large company, they would say, okay, I would have 20 subsidiaries buy. If the 21st subsidiary buys from you, then it's going to be a different price. Things like that typically, you would call it as material rights or variable consideration in the 606 world. Those definitely bring in a lot of wrinkle in revenue recognition. And, let me finish this with a small anecdote. I was working with one of those large security SaaS company, and they were saying that they're using a RPA to identify non-standard terms on their contract from a revenue recognition perspective. And I said, let's take a pause here. Isn't this term coming from your sales team? Shouldn't you know that it is a non-standard term already and exactly what terms are, because it's your sales team which is creating the contract on the first place, right? And the Rev Rec team said, you know what, that's a different discussion for a different day, and then just they walked out, right? So, the amount of non-standard terms that gets creeped into a contract is so significant, and each of them actually have an impact to revenue recognition and needs to be considered there.
Leads me to kind of a different question. Are there shortcuts certain companies take? So I'm thinking about making the customer sign, not being able to return a custom product or a special order, and does that have revenue recognition consequences as well?
Yes, the 606 is very, very subjective assessment, right? Just because you put something in the contract doesn't automatically, get you that key to the kingdom, right? You still need to look at industry, expectations and what is your past behavior and the overall subjective nature of the business itself, right? And actually, it's a very interesting concept, Alan. If you get into that really well, if you are very aggressive because it's very subjective, is there a way you could actually show a higher revenue onto your business because of the subjective standard, right? Yes and yes, maybe, right? And no, maybe that's where the auditors come into the pictures. But the nature of the auditor, are they a conservative? Are they going to push back? And how was PCOB going to be relating to that, right? There are so many other aspects that sort of, plays into this picture from a subjective nature perspective. So it's not just the contract term. Definitely an input into that is a contract language, but that's not the only input to the whole thing.
Ludmila, I think this leads to kind of an interesting, call it an overview question if you want, but there's probably a pretty big difference between the intent of the regulations and their actual application. And I'd love to hear your thoughts as a practitioner of the difference between what were they trying to do and what did they actually get? And does that mean we're going to have another 607 that's going to fix some of these holes?
Yeah, that's an interesting question. I'm speaking to the auditors and working groups a lot about that, right? So I think everyone knows this, or everyone at least at some point of time heard that 606 is a principle-based, while 605 and other guidance before were the rule-based, right? So we went from the prescriptive guidance to the judgment-based guidance. So I think one thing is clear, the 606 is here to stay. And as of now, there are no major revamping projects on the agenda. I think it does serve the purpose, and the purpose being provide a reasonable revenue recognition that could be used by users of the information, unlike its predecessors where users of the information could not make head and tails of what revenue is because it was so choppy, so unpredictable in many cases and stuff like that. So there are, however, a couple of the interpretive guidances that are in the work right now. One of them is the SSP determination guidance. We're all looking forward to get more guidance, interpretive guidance from the CPA firms and working groups about how to determine the SSP. And another one that's big in the project is the gross versus net revenue recognition. So there are a lot of questions about that. I'm personally looking forward for more changes in the variable accounting consideration guidance, but I haven't heard that there is one coming. So generally, what can I say? Did it serve the purpose? So I think it did. However, I was hoping that maybe there are going to be faster shift and emphasis from the non-GAAP measures, such as Jay mentioned, ARR, MER, billings, and other like bookings, right? Non-GAAP measures, whatever company are using, and shift to the GAAP revenue, or maybe at least recurring GAAP revenue. So I think we're a little bit optimistic on that front. I don't think that many companies quite dismiss their non-GAAP measures yet. Although there is more interest from the boards, from the users of the information to the GAAP measures, and the questions being asked about that.
Interesting. We've got another question from the audience here. What are best practices that QOC and contracts companies undertake to build flexibility in pricing terms as well as deal rules? And then I'm not sure who's going to answer this portion of it, but what proportion of customers can run with out-of-the-box solutions? It's a question around how much customization is involved here. And so maybe this is Brian and Jay to talk a bit about how to build flexibility into pricing.
From my perspective, we are highly customized. We've gone through our initial installation of the Aptus RevRec system was in 2016, and we've since then gone through 2 enhancement development projects with the Standav team. We finished one, I think, in 2018, and we just wrapped up our latest last month. So we are highly customized. We are constantly evolving, trying to fit the need of the business, and to try, besides fitting the need of the business, to eliminate manual processes. We had a new CFO come in about a year ago, and one of her top initiatives was to eliminate spreadsheets and eliminate off-system type of tracking. So we spent a lot of time taking things that were being done offline and developing enhancements to allow us to put those into our system so we don't lose visibility of those things.
I think, Brian, now would be a pretty good opportunity for you to tell us a bit about some of those management challenges that you're having, right? And that are being addressed and solved as you work your way through it.
Well, I mean, on a day-to-day basis, and I hate to sound like a broken record here, but integrations are key. So, I spend a lot of time each month just kind of monitoring the data flow between the systems. We send shipment and invoice records from our ERP system over to our revenue management system, and that's what triggers revenue to be recognized. We've got 10 to 12,000 shipment and invoice detail lines a month going from those between those systems. So even a tiny or small percentage failures can lead to a lot of maintenance and troubleshooting, and that leads into your month-end close. And it's hard to, all of us kind of revolve around the accounting processes. So we know when we get to that last day of the month, there's going to be a push to get things processed and recorded so they can get their, whether it be compensation or to meet revenue goals. So, there's always a lot of support around the month-end process.
And I think this is another question for Ludmila. Can you talk a bit about variable consideration versus contract modification?
You're going to ask me this question. Yeah, so that's one of those topics where there is a theory and there is a practical aspect of application of this, right? So in theory, and I'm going to be really brief on that, unfortunately, because I cannot go any deeper on this subject, right? So the variable consideration is something that you make an estimate on the onset of the agreement, right? And you factor into your contract deal allocation and accounting, your estimate of how the contract will end up, your best guess, I guess your best estimate. The contract modification come to play when you could say you didn't do a good job on your initial estimation, right? So, and that's complete misnomer, right? So what I'm trying to say that you just did it wrong, right? So, and it's not a mistake, it's an estimate. And then you need to do the contract modification depending on what it ended up being or what type of the amendment was signed with a client, right? So one is not preclude another, right? So they could work hand to hand, or they could be totally separate things. So unfortunately, I don't think we have time or to go any further on this. Yeah.
While we still have a bit of time, we have about 10 minutes left. Why don't you talk to us a bit about board reporting and how all of what we've talked about comes into play here? And with let's use your team as an example. How do you align revenue billing, sales ops, board reporting, all of those things into a holistic solution, right? We've got all the various players here on the call, but how does it work at your firm, and what are the things that you've learned along the way?
So I'm a big believer in education, right? And I think that the sooner you start educating the board or other users of the financial information, depending who your constituents are, the better off you're going to be, right? So at my two companies where I've been going through the revenue guidance implementation, so we started earlier kind of providing a guidance which direction we're going well before we have numbers, right? So once we had numbers, we provided a transition memorandum to both board members and one of the public companies that I was working for to the public, which basically provide more color than we have to report in the financial statements and more applicational aspect and more discussion about the guidance implementation. So I'm a big believer in the education. Now, with that being said, I wish that boards and users of the information spend more time on gap analysis and gap numbers these days. Unfortunately, we're just moving in this direction. Unfortunately, we're not quite there yet. And I was speaking to the auditors, and they echo that. So there is still a lot of sentiments is that, basically just accountants getting the busy job to themselves, which is obviously not true, right? So, but there is still a lot of sentiments. And I think the more we educate our readers of the information, the better off we're going to be.
Sure. And how critical is the alignment to, say, the deal desk team?
Absolutely imperative, right? So absolutely imperative. Again, that's where education comes to place. So I'm always educating my deal desk and the sales operation and sales people and service people of what's important to the RevRec. And in the same time, the best question that they're asking me, so what's the difference between, let's say, what's important to them, such as ARR or P&L reporting, if it comes to the service organization, and what's important to me for the revenue recognition, right? So, and depending how well can we bridge this gap, right? So between ARR, MER, and revenue, and explain how is it different and what's important for the RevRec, the better off we're going to be long-term. And
Brian, what's worked at your team? What kinds of things have reduced that? We've all seen it, the spike in monthly and quarterly close activities, right? Everybody's miserable. We're staying at work till midnight, 2 in the morning. What have been some of the solutions that have helped you?
When you're supporting sales and finance, you're always going to be impacted by those period end spikes. You have to ship and invoice products. You got to recognize revenue, so that's inevitable. But I mean, the more accurate, efficient system that you can provide to your team that reduces manual intervention can alleviate some of that. I mean, I see our job as IT support from my end is to make sure that operations and finance are not inhibited by our systems, but they automate as much as possible so they can focus on doing their job and delivering to the bottom line.
I think we'll take a brief moment here to talk a little bit about what Standav does here that might be supportive, especially as we work with Brian, right? And the three things we wanted to mention briefly is the subscription management readiness framework. So the idea here is you as a customer come in, you work with us, and we evaluate your quote to cash system and what's working for you and is it implemented in compliance with best practices. We find a lot of cases where folks are self-implementing these kinds of solutions, and it works mostly. We also have some ERP integration methodologies. I know Jay has talked about at least one ERP system. Ludmila has talked about another. We develop tools and methodologies for making that integration between quote to cash over to the ERP system and billing and those kinds of things that Brian's been talking about, that integration all along. And then we also have billing quick start offerings, which are adding billing as a component to the quote to cash side of an ecosystem. Let me open it up for any additional customer questions. I haven't seen any in a while. I think kind of the final follow-on questions here would be, Ludmila, and I think we briefly talked about this, but how do you see the 606 standard changing and evolving? I think you talked about a few elements. I'm curious your thoughts. Is it going to be more prescriptive? Is it going to be more guidance? What's the flavor that this is going to have?
Yeah, so it doesn't look like it's designed to become more prescriptive. So what I think is going to be the post-adoption period of the developing the best known practices, right? So okay, 5 companies in the industry do that, right? So kind of like we want to be comparable to the to our neighbors basically, and we want our financial statements to be comparable as well. So I think we're going to be going through this normalization period. There is definitely going to be interpretive guidance. It doesn't look like we're going to see any major developments in the guidance itself.
Jay, final question for you. What have you seen as the big difference between the 605 requirements and the current 606? Just kind of give us a...
No, I think Ludmila briefly touched on that. With 605, who knows what that number is? There is a number called revenue, but who knows what that is, right? So, it was a meaningless number that was reported out and nobody had any control on that. But with 606, I think there is a good movement towards a number that is meaningful, right? And 605, although for all the complexities was like, the quickest and dirtiest approach you would do is to take all the revenue stream, put it into a blender, hit it out, and just recognize it over the subscription term. It was as simple as that, and who cares about it, right? And nobody bothered about anything. And you can't do that anymore. You have to become so subjective. You need to know exactly what's happening to different terms. It's no more like, professional services, I'm done, I do an invoice, I do it. No. You'll have to look at the percentage of completion. You need to make sure that your upstream systems can provide that level of information to you to get the revenue. I actually have a company which has usage-based, and they actually sell like 1 million usage per year as part of their subscription, and it's a use it or lose it class, and it's a usage-based revenue recognition, and you would say, yeah, okay, I'm going to divide it by million, I'm going to recognize it. No. You'll have to look at the technical estimate usage by customer and then decide what's going to be the total usage, and then do a breakage analysis every quarter, every month. The level of complexity and the knowledge that the revenue recognition system should have from a 606 revenue recognition is phenomenal compared to 605 in my mind, because it's so much more subjective, and each subjective decision that you make has to have a hard evidence behind it. And how do you go about doing that?
I think, folks, we're running out of time here. Brian, I'm going to give you the last word here. Any new management initiatives you've seen, and give us kind of a 1-minute rundown of their impact to existing systems as we know you're continuing to evolve and do new things at your environment.
So, right, I'll try to be brief as possible here. So like I mentioned earlier, we're constantly evolving. We've had 2 enhancement projects with Standav. So an example of this last one that we just completed, we have a new type of product out of our positioning division in the UK where it's called embedded maintenance. So we sell a hardware product, and along with that hardware, we offer a year's support. Previously, we manually tracked that portion of the support. Say it's 10% of the hardware price. We had an offline system in Excel manually tracking that. Well, one of the enhancements that Standout did with us was to install what's called a split policy. So for a single product, you can split out, say, 90% to your hardware, which gets immediately recognized. The remaining 10% of that revenue gets ratable over the next 12 months or 24 months, or whatever that period may be. So that's a good example of the kind of enhancements that you have to constantly be doing.
Brian, thank you for the last word there. Everybody, that's the end of our presentation. I'd like to thank you for spending an hour with us. Jay, Ludmila, Brian, pleasure to have you all on our session and give everybody some insights here. We really appreciate you taking the time out of your busy days to help us out with this.